Sorry. Right, this is Ken Long from Tortoise Capital with a review of the weekend trading reports for May 16th, 2015. Our market is still in bullish normal conditions on an annual basis using weekly RSI 14. We're in the higher end of neutral at 60 out of 100. On the shorter term 10-day basis using the 10-day NDX, we are well overbought at a score of 97 out of 100. Looking at the market mosaic, price with respect to the 200-day moving average is white bullish at 5.14%. The slope of the 50 is yellow neutral at 0.10. That's actually an improvement over last week. ADX remains weak or untrending at 12.9. The risk index is the 30-period moving average of the VIX divided by the 10-period. The threshold between risk on and off is 1.0. The current reading is 0.979, so we're into risk off conditions, slightly into risk off. If we take that score of 0.97, compare it to the last 5,000 trading days, and find the average and the standard deviation, that lets us compute the risk Z, which right now is at minus 0.32. This histogram shows the 90 days, the last 90 days of the time series of that indicator, and you can see that we're right down here just slightly into the red at minus 0.32, where we had we're now forming a triple bottom, not very volatile at all, not very risk-off-ish. The last time it was here and it made this nice little move, this turned out to be a pretty good little swing trade in XIV, and it was part of the equity move to retest the highs where we are now. So that's actually pretty favorable conditions. If we can get some equity movement here and some follow through, I would expect this to go back up into the green and put us into a position that's very favorable for long side swing trades. All it's going to take is a little bit of follow through here in the equities. You can see the blended monthly rebalancing holdings. Our next evaluation is due on about 1 June. This is the current holdings of those portfolios, or the current leaders of those portfolios based on the price action at the close on Friday. Still Japan, Asia, and Euro blend, DFA, and the emerging markets. And then in the ETF 32, it's China, Japan, and then small cap Europe. So 100% non-US right now, which is the first time in a long time we've been able to say that. So that's part of this shift away from the strength of last year, which was the US large caps, and more towards the global positions, especially with strength in Europe. I think that's just a reflection that the banks are paying negative interest on money, and they're doing everything to get the equities pumped up. So that's a macro economic trend that I think will be persistent. In ETF2, the theoretical exposure remains at 100%, the model's at 100%. That had a 30% shift in exposure to the European assets, which is well started this week. We had a couple more folks sign up for the workshop in Kansas City coming up in June. They are doing some great work already. I think the workbook and the videos that we'll be making from that workshop are going to be very interesting. I should also note that IITM has completed their work on the swing trade workshops that I do for them. They've actually turned that into 2. They've taken the last 2 workshops I've done and pulled the highlights out, and are making a kind of a basic skills and teaching the channeling and the overreaction, and then a follow-on set which gets into the more technical systems like 5DD, 551W, triple screen, the auto framer and such. And I believe they're going to release that this upcoming week. So you might be interested in that. What I have committed to doing, you may have noticed in this weekend report, is soliciting all of your questions on our style of swing trading. And I am going to make a supplemental home study course out of that, out of all the questions and answers. Plus, even with something like 24 hours of video, I don't get to cover all the things I want to cover in the workshops. I'm going to go through all my hundreds of slides and basically produce a comprehensive, definitive home study work course that will supplement what IITM has. Now that's the basics, I think, the core material, but there's a lot of subtlety that I don't have time to get to in the workshops, and it's about time that I commit that to disk and make that available. So a couple things to look forward to. The weekend report had a link to the Survey Monkey that's collecting any questions and answers that or questions you have for the swing trade, and I will be building the supplemental from that. In addition, I'm going to do a simplified version of my spreadsheets for doing daily screens for those systems and make them available to the folks who buy the IITM workshops. And I'm going to put those into the chat room and make it a little bit easier to scan for more symbols, because what I do is typically just work on the Dow 30 and the ETF 30, but I'm going to expand those out to accommodate 500 or 600 symbols, and I'm going to do that later tonight and hang them in the chat room. So those of you with chat room access can download them there. Okay, so let's move on. All right, these are the current holdings and performances in the various BMR portfolios, ETF 13. Again, you can see Japan leading the way, and then it's really all of the globals. Now, technology is up in there, but it's really the globals. And treasuries and real estates, the defensive plays, are lagging right now. And that's the same story in ETF 32. The China, Japan, emerging Europe, the EAFE index, EFA. And then the first things that show up from the U.S. are the healthcare and consumer discretionaries, XLV and XLY in position 7 and 8. So those are, I consider those to be defensive plays. And to me, what's interesting there is that as the money flows out of the U.S., you have money, I think, going, the U.S. money being redeployed to the defensive sectors as the larger indexes start to sputter, if you will. That's what I think is happening there. ETF Max reflects about 1,100 ETFs, and it uses the BMR strategy to rank them. And the ones that are interesting to me, the China Industrials is kind of interesting. It's in rank number 2, but notice that it's got the significant sell-offs on the 1 week and 1 month percentage, although the 3 and 6 month are really dominating. So that tells me we either have a turning point in China coming up. You'll notice down here the China materials are in the same boat, and really the financials to the same extent. That's either overheating in China, and this is part of that first sharp pullback, or this is an opportunity to start stalking the reentry on China once these start finding their value plays. But you'll notice FXI, FCH, all of the Chinese symbols are in that same category. Ireland's kind of interesting. In the position number 30, all greens across the board. Copper still looking good here. I like it in position number 25. This is healthy for the business cycle. Same thing with CU. whites and greens, and that says that the strength is more recent. Global carbon may be something that is supportable from a tactical trading. I'm going to start looking at that. I can't believe I didn't do that last week. Still see some strength in Russia based on the rebounds in energy. So this is clearly a story of potential growth that's outside of the U.S. and starting to find support in different areas, and some value plays in China that are of interest. Looking at the S&P 500, some tradables here. Netflix in rank number 1 is solid greens across the board. Yum Brands, Y-U-M, solid greens across the board. Newmont Mining, N-E-M, solid greens across the board in the 10th position. Amazon showing a bit of a pullback here on the 1 week. Paul Corporation, PLL, I guess we got to take a look at that thing. Holy mackerel. So we'll look at PLL. I want to look at Netflix, NFLX, Yum Brands, Newmont Mining. And I'm going to be looking at these in terms of potential swing trades because I've been working on some swing trading disciplines for my portion of the research weekend. That will be in the workbook, by the way, for the distance learning folks. Shifting to the health check. All right, so what we have in the dark blue shaded area in the middle is the river. That's the 30-period Bollinger Band plus or minus 30. 30-period Bollinger plus or minus 1. And then the floodplain is the lighter blue shaded area. That's the 30-period Bollinger Band plus or minus 2. That red line in the middle, thin red line, is the middle of the river. The red shaded area is the dragon. That's the 10-period Bollinger Band plus or minus a half. Notice the dragon and the river are all sloping up. The dragon's in the upper half of the river. Prices in the floodplain hasn't broken out above the Z plus 2 yet, although it's testing this high previous swing higher at 212.5. And so with the ADX being very low, which you'll notice up here, ADX is down below 15 still. It's at 12.86. And what that means is that this choppy condition we've had for the last really 50 to 60 days will support a strong swing trade type move once it gets underway. What you've had is a lot of backing and filling here, but the general slope of everything is up. You'll notice that the 30-period regression channel is sloping up. The 10-period is sloping up with an acceleration above the 30. We're testing the new swing high. The slope of the 30 is actually down compared to where it was. So this is not overheated by any means. This is a grinding upward push. And if we can get this breakout here again above 212.5, if we can keep that sustained, then it looks good. We're in the green zone, and that means that I'm generally looking on the long side for intraday trades as well at the first sign of strength. So if we can keep the support level in here around 210 near the bottom of the dragon and the Bollinger Band mean, we are very comfortably positioned for a good long upward move. What could that look like? Well, if we just look back to February, we saw a move from about 197 up to 212. So that's 15 points. And so it wouldn't surprise us if we come up here in about 6 days ago, we have this intermediate low around 207. Add 15 points to that. This could go another 10 points up to 220, 222, well within the bounds of normal moves inside the S&P, particularly given the fact that the rest of the world was starting to find some strength too. My only concern there would be is that the leadership right now is overseas, and so we may not see the big follow through in the U.S. indexes. But I take this as a proxy for health in the world, that if we can get above 212 and hit all-time highs in the S&P, that the other relative strength leaders should go up in sympathy or in parallel. And then I would expect us to see really big moves in the other indexes, basically as they try to play catch up to the U.S. And so that's where the broad index in Europe, like IEV, should continue to benefit. So that's my read on the on this local, the market conditions and the market health check. I consider this to be very favorable for swing trade moves to the upside here. If we get failures, then the first targets are going to be back. Let's just mark off some of those. Failures that we'd be looking at. Sorry. The first price level, failure of support here would be back to test at 210, which is the bottom of the dragon and the 50 period or the 30 period Bollinger Band mean, the red line. The bottom of the river at 208. Big support here at around 207, which is Z minus 2, and is this previous swing low, and then this cluster of price action over in here. So if this violates, then the next one is 205 down here around Z minus 3, and then this about 60 days ago, this support level at 205. This would get us back into sideways conditions right now. So that's the price ladder on the way down. Support at 210, 208, 207, 205, and then 203. And then range expansion to the upside is another 12 points north, which is about a 6% upside move just on a technical basis. Okay, moving on. Next up is the regional report from ETF2. Everything's on a buy signal. So the allocation strategy is still 100% long, 0% cash. Right now, EFA is stronger than SPY, so EFA at 55 in strength is stronger than the S&P at 49 in strength. So that means we would favor the globals over the U.S. And then inside the U.S., it's technology at 50, mid caps at 50, small caps at 49, S&P at 49. S&P bringing up the rear. The two strongest sectors, EWJ at 58 and EFA at 55 on the strength, and then the two weakest, Latin America and SPY at 48 and 49 respectively. Inside the U.S., now notice, 3 months ago, most of these would have been green with the residual strength in the U.S., and we watched just a steady decay of the U.S. relative strength, sector by sector, index by index, to the point now where it's really only the defensive plays, healthcare and discretionary, XLV and XLY, are still holding up well. And then technology, I think it's still the Apple effect, and then there's been some bounces there in Microsoft and Intel. But right now, it's really just the defensive plays inside the U.S. In the world market model, everything U.S. is slightly above average except small cap value, which is in the yellow at 47. The outstanding strength is Japan, China, Hong Kong, Switzerland, Netherlands, Austria, and private equity. Above average across the board in Europe and all the European countries. Again, 3 months ago, that was all red. And now you notice that the currency imbalance is partially to an explanation for that as the strong dollar starts to weaken and the euro is rebounding. ETF top 30 just reinforces the same things we saw on the BMR view. Italy I like here, it's at green and white, and I like Switzerland in the green and white. But otherwise, it's the usual suspects. It's China, Asia, biotech, the Asian and European countries. Even Spain is coming along in the white and yellow, so that's earlier in its life cycle. So that sort of reinforces the same messages we're getting from the BMR lens. Inside the Dow 30, just notice again, this is equally split now between green, white, yellow, and red under the strength column. And 3 months ago, this was mostly green and white. There was like one symbol in the red. So the two new leaders coming to the top, Goldman Sachs is green and white, Nike green and white, and JP Morgan green and white, with longer term strength in Disney and United Health. United Health looks to me to be sort of a standby go-to position, a conservative growth story still among the U.S. large caps, because it's top of the Dow. It's in the healthcare sector, which has been gaining ground. So hard to go wrong with UNH as a core holding. Real weakness coming in here reflected in red and yellow, and that would be Chevron, DuPont, and Walmart. Travelers also weakening at yellow and white. But on the way up, yellow then red would be Caterpillar and American Express. So that's early in their cycle. So we'll take a look at CAT and AXP on our charts of interest. Okay, so let's quickly shift to the daily report. You'll notice no signals in overreaction or channeling. Volatility has basically flattened out here in the lower end of normal. ADX right now still below 15, so non-trending. We've only got a couple pattern trades. We got XLE on the triple screen. We got XOM on 551W. I like both of those patterns, so we'll add those to the list of charts of interest. Cliff in the auto framer. Disney in the auto framer. I like Disney because, again, it was one of the two strongest in the Dow, so we will definitely look at Disney. And XLE in the auto framer because that's also the triple screen, so we like that. Inside the ETF, oh, whoops, I skipped over one here. Let's look at the Dow Tactical. No pattern trades really to choose from, but just notice there's a lot of frog quality numbers, nothing on the RSI 2. Yeah, Nike looks of interest to me. That was that strong one in the Dow. It has no patterns, but it was a % winner on Friday, strong frog, and notice how it's been outperforming over most of the time periods and is very nearly broke out of its 10-day, 1 month, and 3 months. So Nike, to me, looks like it's poised for a strong move as well. Maybe there's some follow-through available. Also, Goldman has no patterns per se, but you can see it's been positive on every time frame and is right. It closed at the highest high of the last 10-day, 1 month, and 3 month. So Goldman Sachs is one that looks like a clear winner inside the financial sector. So I think as long as there's broad weakness in the U.S. compared to the globals, it's much more a stock pickers market for the U.S. And so now I think this whole stack of the Dow companies, that's where we can make some relative money. on a relative strength improvement. So rather than buying indexes, it might be in the U.S. time for symbols companies. Among the ETFs, Treasuries is interesting. It's in the 4th position here in the max pain range compression. Got a strong fraud quality number, was up big on one day, and then we'll notice it's got an RLCO Z pattern trade, so we're going to frame that one up. Otherwise, lots of good fraud quality numbers, a handful of dojis, and then the 5-day down in volatility. That's still good for intraday trading. If we get some follow through to the upside next week, then watch for that to crater, and that tells us XIV for the long side. And then finally, just some notations from the auto framers. Some of the usual suspects, DuPont, Cliff, Disney, Merck, and XLE. And then from the regression line fractal framework concept, I like this one here in Treasuries is 6 ATRs below its 270 period. I like it just for that reason alone, the fact that it had such an extreme beatdown that you have to believe that reversion to the mean is a real possibility. So we're going to take a look at that one pretty close. The other one in that sector, LQD, is that corporate bond, which is 3 1/3 ATRs below its fair value. And then these symbols in the red are the ones that are the most number of ATRs above their own RL270. So these are the strength leaders: IBM, Caterpillar, General Electric, Morgan, Chevron. I like those. We're going to take a look at Walmart. Again, that was a value play in the Dow that I'm always interested in. When it gets beat down that far, kind of hard to vote against the U.S. and America, and Walmart is certainly that. So it's 4 1/3 ATRs below its fair value, so we'll take a look at that. Okay, so that should give us enough charts of interest to look at, so we will shift over to that next, charts of interest. Okay, so the first one we'll look at is Treasuries, only because I already had that one up. Waiting for that to come up on your screen here. Should be there in a second. There we go. Okay, so just as a point of refresher, a couple of weeks ago, we set up this trade frame where we were stalking here. We got the entry looking for a return to the 270. However, it failed, and in this sector here, it gave us a 1-hour loss, which we then did a stop and reverse. We got the swing trade down to here. We got a second position at the second red bubble. We ended up cashing both those positions at this green bubble and then have been stalking it ever since. We got the 1, 2, 3 entry on Friday, and we got it here at for the swing position at 121.59 with a stop down here below the swing low, like a $3 stop. Our target, this is what that RLFF looks like. If you recall, that was something like 6 ATRs. TLT was something like 6 ATRs below its RL270. So this pink line here is the RL270. This distance here represents 6 ATRs in treasuries. that is about, I think it's like $1.80, and so this is about a maybe 1.5 ATR stop. So this gives us a very reasonable reward to risk ratio here. So if this one were to only get halfway up and just revert to the mean and stall, then that's one that I'm very happy to cash. And so for me, the checkpoints where it's got to clear, the ladder of success is like 122, which is Z minus 1, the edge of the river. The 90-period regression line here about 124.5. The Bollinger Band mean about 126.5. The far side of the river at 130, and then the RL270 up here by 132. So all of those become places where it wouldn't surprise me to see it fail. If it were to fail below Friday's low, in other words, fall out of the dragon, I could be tempted to go short treasuries again, especially if it clear. I have to be short not later than our initial stop loss, because you notice there hasn't been any price action over in here at all. This is a great big vacuum going back well over a month. So I really like treasuries in that trade frame. Let's try the. How's the audio now? We okay? Testing the audio again. How's this? How's that now, Peter? Okay. Peter, that may just be your end. No problems on the other side. So hopefully you'll be able to catch what you missed on treasuries with the recording. If we look back further, this is like about an 8-month look back in treasuries. You can notice the magnitude of this move. Notice what has happened on the Bollinger Band range, the range expansion of the Bollinger Bands. After this period of cluster in here where the Bollinger Bands pinched and we get this violent move to the downside, just notice how far back that goes. You can see that it has come all the way back here to that support level. And again, if that one fails, it comes all the way back to 113 as the next leg down. So where we're at right now is that if you notice that action of the 270, it has been steadily upward until about 10-15 days ago, and only now has started to roll over. So this is I take this as a intermediate trend change. I think that is reflective of the weakness in the dollar and a shift to other assets. This is a period of time when, hey, for the last 2 years, the U.S. has been the source of strength in this market, and the globals have just been getting crushed. All you got to do is look at Latin America. But this is part of the air coming out of the balloon for the U.S., and that is it takes a move of that magnitude to get the 270 period regression line to roll over. The fact that it is should be a real source of concern. I expect a lot more volatility as the bond traders start sorting all that stuff out. So if I were to look at this on the longer term then, if the channel truly is rolling over to the other side, now what that channel for treasuries looks like is this. If we start connecting these lows and then connecting the highs, it now looks like this move in treasuries should only, we wouldn't be surprised if this were to bounce and come up to the Bollinger Band mean and then fail right around here and then get some more of this action. That's kind of the same price action that you saw on the way up, where price would bounce around in this frame. Now this rolling over period is telling us turning point is here, and we've already established 2 lower highs and then a big collapse to the downside. So really the more realistic move here is simply back to the shorter term Bollinger Band mean. But I think these are some rough times ahead for the U.S. Treasuries. That's a real possibility here. What that will do is set up, maybe it's just time to start blaming the administration for economic woes with the weaker dollar as a run-up for the next 18 months to the presidential elections, and being able to pitch this as a really weak landing zone for the U.S. Politicians can blame Obama on both sides. They can blame each of the other parties for the economic weakness, and then economics will become the main theme of the presidential elections in about 18 months. So this is part of a give back of this minor improvement in the economy we've had for the last couple of years. So that's how I think this plays out on a macro basis. That's just me talking out loud and trying to establish a long-term lens. Has a slight impact on tactical opportunities for day trading and swing trading, but that's the mindset that I'm going to be prepared for. All right, so next thing, let's take a look at some of these new symbols. I haven't looked at these before, but because I think this is a stock pickers market here in the U.S., let's take a. This is that one that popped way up. This is PLL. I have no idea who these guys are. Paul Corporation Manufacturing, but I have to believe that it will be hard to sustain that kind of growth. And so what I think, the way I use the regression lines to frame this is I think you end up taking extending this regression channel here. I think we draw this line across and draw this line down. I think somewhere up around 114 is where this price gets to in the future. Who knows? Could this continue to bounce up? It could, but it's been 3 days without any additional follow through. So the long, slow grind is much more likely to be the case as people start getting concerned about protecting this gap up move. I would say any violation below 117 is an auto short. So this is obviously too late to get that move, but I think if this line violates around 117, then what you do is you play that for a return to this, what will be the projected mean of prices up on that line. So if it were to fail here shortly, there's some moves. There's also a move down here, the first leg down to 117. That's going to be the way I would play that. Could you also put a buy limit order there to gain some of the upside? Sure, I suppose, but to me, in a manufacturing company, this is where the surprise has already baked in. Now, the guys who made those gains are playing defense, and I think that's how this thing gets reevaluated. Rising expectations of fair value, and people concerned about protecting these two massive steps up. So that's PLL. Let's take a look at Netflix next. Boy, you gotta love Netflix. Everything looks good here. I will be buying breakouts above the daily high. Everything positive here. After this is that it has digested those gains from the last move up. You know, you take a look at this little gap up. It has held through 30 days, and now we're getting range expansion to the upside. Fair value still down here at 469. Support at the southern end of the dragon. Bollinger Band mean here. But this one looks to me like an opportunity to the upside and range expansion. If that fails, then the price target on Netflix is back to the bottom of the dragon, around 574, then the 90 at 567, the 30 at 539. That's your price ladder on the way down if you get a violation say below Friday's low at 602. So those would be your targets, 1, 2, 3. And then if it fails below here, then that puts this entire 30-day period at risk, and then it's a rapid run back down to this previous price level around 483. So that's the structured approach on Netflix. Next one for us is Yum Brands, Y-U-M. Sure, everything to like about Yum Brands here. I think there was obviously a lot of buying in here at this price level, and all it has to do is take out the previous swing high, and then off it goes with a support level at the bottom side of the dragon. Again, failures there. If it fails below 91, you could say the bottom of the dragon as a target, the 90 as a target, the 30 as a target, the 30 moving average, and then the long-term price down here around fair value, which is got to be around 80. So that's the natural extension of the 270. So this is the growth story in Yum. Is if you believe the growth story, you buy the breakout of the high, and then off it goes, and then manage the stop, and then use market's money to add to the position, and then preserve your gains. But on failures, I think you have to see a failure below this price level, the bottom side of the dragon, before you would really want to get short, and then there's your price ladder. So that's Yum Brands. Now over to Newmont Mining. This looks very good to me. Yeah, we're looking like at testing the 6-month high. Yeah, I like that. That's already taken out the previous high. And we've got this series of higher lows. A double bottom, a double bottom. This little cluster here has been completely left behind, and that becomes a really thick area of support around 25. If this failed and came back into 25, there would be a lot of buying. All these guys in here who gained this would be ready to buy it. Everybody who felt like they missed the easy move would come back and buy it if it found support here. But now I think we can buy this. We can have a buying program where, as we see prices expanding, let's see, let me get this pen in here. Yeah, I think if we get a price above that new high, that's an auto buy, and then off it goes with the stop down here around 27. So buy 28 with the $1 stop. I like that a lot. So let's put that green line there. I'm going to frame this trade for tomorrow, and we'll put our stop in here. That's my trade frame there. If it fails through 27, I will go short down to 26. So that'll be my target on the downside. We'll turn that one to purple as the price target on the downside. And then if it fails through that, I would add a second position with the idea of reaching down here to 25. Okay. And then if this goes to the upside, I'm going to manage this to get to no lose as quickly as I can, and that's what I'm looking at for Newmont Mining. All right, let's take a quick look at some other ones. We're starting to run out of time here. We'll take a quick look at Nike. We mentioned you have to love Nike right here. You're just starting to get the range expansion. This is a beauty. This is already a winning position for us here. I like that one a lot. That's range expansion and unlimited upside. Look at this. We're looking at a 3-year, 2-year high. Off it goes. I think, and it's right. It's just at fair value, long-term fair value. And so, one of the ways we can estimate the size of the next move is we can take a look at how far down below fair value did it get, and how far above fair value did it get. That's how far. So that tells us it can get to, if we just use symmetry, it can get to 108 with ease. If it gets to 108, off it just goes. So take a look at that strength in 270. This is really nice. When you see that, now when you see these little turning points down here, this move here from about 101 was kind of key. Even this entry here at 103 was good. So that's what real strength in the U.S. market looks like. That is clearly a stock that is not suffering from the doldrums of the rest of the U.S. market. So that is a symbol, that is a leader. All right, so let's look at Goldman. Goldman Sachs in the same position here. All it has to do is get above 203 and off it goes. You have your stop down here below the 270, like at 199. So you're talking about a $3 stop, and then off it goes. Goldman's in great shape. Let's look at Exxonmobil. I think ExxonMobil gives a possibility here. It's held support at 86, giving us almost a 1, 2, 3. I could see this with a trade frame that looks like that. The idea of it getting up to 90. Failure below 86.5 is you're looking at 84.50, and then back to really even 84 back to this location. So ExxonMobil is of interest. Caterpillar and American Express we want to look at, and Walmart. So here's Walmart because we're just right there. I love Walmart in that position. I will take that trade right here with an entry about 79.50, with a stop down here about 78, with a target about 84, which is the fair value. I like the fact that for the last 20 days it has put in this. It has failed to fail further, and you got this nice little cluster, and you have upward price action on the lows, and it's gotten back to the Bollinger Band mean, and you have a narrowing range on the Bollinger Band, so volatility declining, and yet there's still a nice move available up to the 270. So I like Walmart as a value play. Let's look at United Health. This was the strongest symbol in the Dow. Now, this is the case where we're already about 10 days late on this. This is the argument for that regression line fractal framework, is finding strength. Because take a look at the strength in that 270. It has been nothing but up. And now we've got the pullback to the Z minus 3. And then where the Z pattern tells us is we should be buying this at 113 when it goes from Z minus 3 to Z minus 2 with the stop down below the Z minus 3. So that should have been, we should already be $6 and 2R in hand on this one, simply on a retest back to the 270. But it's at the 270 right now, and so now everybody that owned this on the way up now feels safe about this position, because for 15 days it's done nothing but recover, and it's back to its previous fair value. And now if we take an extension of this, we will see that these guys are thinking 127 is the proper fair value for that. So I can see buying a new high, a breakout from Friday's high about 119.70. But just recognize that when you get these long-term relative strength leaders, and healthcare has been strong, and you get the pullback to Z minus 3, that's the alert to look for evidence of support and then buy it back to fair value. That's buying quality on sale with a target of fair value longer term. So that's United Health. Let's take a look at the last one for today is Caterpillar, and then we'll call it a night. Caterpillar in good shape here. Nothing special about it other than it held support here at the edge of the river, edge of the dragon. So if we got a breakout above Friday's high here, I can see this continuing to go to 91. It's still early in its life cycle. This long move of the last 30 days is enough to turn this downward slide to the upside. And I think that's the same thing we're seeing in Newmont Mining, which is further upstream in the business cycle, being basic materials. Caterpillar's a little bit further downstream in excavating equipment and basic industrial processes. So maybe what we're seeing is a beginnings of recovery in the business cycle among actual producers of things. The final one, let's just look at American Express while we're here. So AXP. It's fought its way back to fair value, and so really the extension above fair value would be if it would be back to here and really here. So that's the upside. Now it's already started to fail. So what I would say is if we get failure below 80, I think we could play it back down to these support levels. That would be consistent with this declining 270. The only reason I think there may be some long-term, there's a lot of support down here at 78, so that it's sort of a tactical play. I really think there's a lot of support in here at these price levels. And this little wedge to the downside, I think, is going to get resolved to the upside. I think we're getting ready to see a secular upward move in American Express. They have been defending that 78 position with a lot of strength. All right, so that's a dozen or so trade frames for the swing trades for the week ahead. That should keep us well occupied. If there are no questions, I will get this produced and hung on YouTube, and then the link posted in the chat room as well. So thank you guys for your kind attention. I would invite you to think about being a distance learning supporters of the research weekend. There's going to be at least 15 quality presentations and a lot of trading videos that we're going to be taking from the live trading. So the workbook for that is going to include not just the research weekend, but also trading lessons we do from the live trading week, and that's going to include a lot of our sessions on how we prepare for the daily trade, and then trading case studies we make during the week, and then our after action reviews. So really, I think a lot of quality stuff going to be put into that. So I would invite you to think about signing up to be a distance learning member there. We'll be making DVDs and workbooks of that whole week available to help offset the cost of putting that thing together. And That's everything from Kansas. Um, take good care of yourselves. Take care of your families. Look to do good. Maintain that good quality state of mind. Share your gifts with others. Take good care of yourselves. We need you. And you guys have a good week, and I'll see you in the chat room.